Hi, I'm David Hall, and I want to talk to you today about the 3 biggest accounting mistakes that you might be making in your own business. So the first thing that you might be doing is not doing any accounting at all. And that is more common than you might think. So what is no accounting at all? It means this is how much I have in my bank account. That's the accounting. All right. And I hope that just hearing that statement resonates with you on how you're not really seeing what's going on with your business. Number 2 is an accounting that I call an accounting by the checkbook. In other words, you have a checkbook, right? You write checks and you take money in, and you'll account for those individual checks and the income coming in. Okay? So you might say, well, that's good enough, isn't it? Well, here's the problem with that, is it only basically keeps track of your money in and money out. And believe it or not, that's not all that accounting is. It's a lot more than that. An example of that is that if you had a service business and you decided that you would buy a building to have your service be run out of. And let's say you spent $2 million to buy this building. So with a checkbook accounting mentality, you would say that you spent $2 million on something that you might call building expense. And I'm sure you understand that a building, if you buy a building in your business, it's going to give you value over many, many years. So the concept of depreciation comes into play. So when you buy something that is, quote, an asset, something that gives value over more than 1 year, you should capitalize it and then depreciate it. So what does that mean? It means that you create an account called building on the balance sheet and you keep it as an asset, just like you do your bank account balance. And then you depreciate it systematically over the years that it serves you. So that's true for buildings, it's true for equipment, it's true for vehicles. Any type of asset that's going to give you service for more than 1 year, you want to capitalize it and depreciate it. So that's an example, just an example of one thing that would not be effective in a checkbook accounting. Number 3 is a cash basis accounting versus an accrual basis accounting. What am I talking about? Well, a cash basis is how most people think about accounting. In other words, if I spend money, then there's an accounting for that. And if I take in money, there's an accounting for that. But there's little else. But in an accrual-based accounting it's a concept called the matching principle. So in other words, let's say that you are in a service business and you collect money in advance. I know as a CPA, I collected money in advance and called it a retainer. And let's say it's $10,000. You collect $10,000 in advance, and then you do the work over the next several months. Well, here's the problem. If you take in the $10,000 and you call it income when you take it in, and then you use a couple of months to actually do the work, and you have staff that are paid over the next couple of months, you don't match up the income with the expense when it actually occurs. Does that make sense? So there are all types of items that accrual basis will apply to. It applies to expenses that you incur the expense long before you pay it. Or again, like I just mentioned, you receive income, or I'm sorry, you receive money as a deposit for services to be rendered, but the services to be rendered in a future period. So accrual basis takes care of all of that. It matches up the actual earning of the income with the expenditures that are associated with the income. That way you all have a true picture about how you did in a particular month versus a cash basis that really could put you all over the map. Okay, in summary, the 3 items that we've talked about today. Number 1 is no accounting, which is not going to work. Just having a checkbook balance is just no way to run your business. You just have no idea how much money you're making, and so we've got to move beyond that. Number 2, a checkbook accounting, which accounts for the checks that you've written and the money coming in, but it still is a cash basis accounting that doesn't reflect assets that are being purchased, doesn't reflect liabilities that are incurred. It strictly goes based on a cash basis. A simple example is if we got a loan from the bank for $500,000 and we had this kind of checkbook mentality, we would say, okay, we took in $500,000 and we have $500,000 of income. No, we have a loan, we have to pay that money back. So that's where the checkbook accounting just does not cut the mustard. And finally is a cash versus accrual. And only an accrual-based accounting is going to get you the right allocation or the right matching of income and expense for each period. So anything else is distorting the numbers, and you're just not going to have a good sense of what your operation is really doing. So if you'd like to have more information or find out more about me, David Hall, or our coaching program, the Breakthrough Coaching Program, please go to our website, mybreakthroughcoach.com, and you'll find more articles, more information about what we do. And if this topic was good for you, we'd appreciate your feedback as well. So thank you, and I wish you the best with your business.